All right, good afternoon, everybody. Today is Thursday, January 27th, and I'd like to welcome you to this week's installment of C-Suite Snacks. My name is Steve Ronan. I'm the leader of Citrin Cooperman's consulting and outsourcing practices and the host of this webinar series. Well, the more things change, the more they stay the same when it comes to M&A. After a record 2021, more businesses than ever are looking at transacting in the short to midterm. And at this point, it looks like 22 is going to continue apace. This means that buyers continue to have more buying options than bandwidth with which to execute transactions. And due diligence, including sell-side quality of earnings, is a more important gating criteria than ever when buyers are determining whether to move forward. So how do you make sure your financials are as clean as possible? Today, we're joined by Peter Colgan from Citrin Cooperman's Transaction Advisory Services, or TAS practice. Peter leads clients through the nuanced process of prepping their financial records in advance of a sale and performing sell-side and buy-side quality of earnings reports. During this, he works with business owners, investment bankers, finance departments, potential buyers, and financial sponsors to determine the true financial state of a business, and finds that more than any other, the quality of a company's financial records are of the highest consequence, and it's generally one of the most intensive parts of the due diligence process. So Peter's going to join us today and use this wealth of knowledge to speak about how you can start to prep your financials for a potential sale ahead of time to reduce risk, streamline due diligence, and get through a clean quality of earnings report. As always, we ask you to submit questions throughout the webinar, so please locate the Q&A button on your Zoom screen and feel free to enter your questions there as we go. We will save time at the end of today's presentation to address the questions we receive. We will also be doing our weekly snack basket giveaway, where a lucky attendee from today's session will win a craft basket of snacks. The winner will be announced at the end of the session. And finally, if you're here because you found the invite on our website or on social media, I encourage you to sign up for our mailing list to make sure you receive an invite for our new snack-sized topics each week. Please also visit our C-Suite Snacks Content Hub on our website to view recordings and look through the decks of prior presentations, including today's. And without further ado, Peter, I want to thank you for being with us today, and I will turn it over to you for today's session.
Hi, Steve. Thank you for the introduction. As Steve mentioned, today I'll be discussing how you can help prepare your company's financials for sale and the importance of building your team. So high level, what we're going to discuss today is the importance of building your team, and I'm going to provide an overview of significant advisors that you're going to want to have on your side when looking to sell your business. I'm also going to discuss at a high level the importance of adjusted EBIDTA and net working capital. And then after your financials are prepped for sale, I'm going to discuss what's next and take any questions that you may have. All right. So you want to sell your business. What's next? The most important thing to do initially when you're looking to sell your business is to build your team of advisors. So it's critical to build your team of advisors to match your buyer. Typically, whatever buyer that's going to come in that might be interested in buying your business, they're typically going to be a larger entity with strong resources and that have experience in the transaction process. So it's critical that you have a group of advisors to help you match against their advisors so you're speaking the same language and that you get the best possible deal. Okay, so what are the advisors that you need? One of the first advisors that you need to get involved in the process is an investment banker. The investment banker is going to help market your business to attract potential advisors and really let you know what you have. In addition, they will help you find a buyer. Next, you're going to want to engage in a sell-side financial due diligence team, which is what I do. And we're going to help validate some of the findings that the investment bankers have on the financial side, help you quantify adjusted EBITA, help you quantify adjusted net working capital, and any other financial analysis that you might want to see or that an investment banker might want to see to help market your business. And last, but certainly not least, an important advisor is going to be your own internal accounting team or whoever is handling your books and records if that's potentially outsourced. Your financial reporting team is going to be responsible for providing information necessary for the investment bankers to market your business and for your sell-side accounting team to analyze your business. They're going to be responsible for answering questions surrounding trends, what activities flowing through accounts, and other relevant items that a buyer might be interested in learning about. Okay, so how does a broker help market your business? What exactly do they do, and why, do you need to hire an investment banker? So essentially, they're going to help you market your business, and the primary way that they do this is through a confidential information memorandum. Essentially, this is a massive packet and slideshow. It's an analysis that will kind of provide an overview of your business in a multitude of facets and help attract a buyer by showing your business in the most positive light. Some of the high level things that they're going to touch on here are operations. They're going to explain what services you might provide or what products you sell. They might want to highlight some key operating metrics that help make your business look as attractive as possible and compare them to your competition. Some example of some key KPIs that I've seen in confidential information memorandums include sales per marketing lead or labor cost per product. Some other operational items that they may also want to highlight are your facilities, your equipment that's used to run your business. They're also going to want to discuss your strategy. How is your company establishing a competitive advantage? Has the strategy changed over time? How are they moving forward? How successful has the strategy been? And et cetera, et cetera. They're also going to want to highlight management. Who's running the business? What's their experience? How can they help grow the business going forward? And they're also going to want to discuss your employees. How many employees do you have? What are their functions? How do they help run the business? And last but not least, the area that I'm most involved in is their financial overview. They're going to provide a financial overview where they might provide some charts and analysis that will analyze sales by service or by product, or they might analyze things such as margin by customer, sales by type, sales by geography. They will also analyze kind of your vendors who you're purchasing from. And last but not least, they're going to give a high level adjusted EBITDA calculation, which I'll discuss further. So high level, as a seller, how can you be prepared to kind of start this process with your investment banker? So one of the most important things that I think that you can really do is to start gathering information as soon as possible. So the investment bankers, they don't have this information. You have to go to your internal accounting department and get this information from your financial reporting system, your financial analysis system, and any other operating systems that you may have. So if this is your first time trying to sell a business, sometimes it can be challenging understanding what's being asked, how to pull the information, and other items like that. So it's important to kind of start the process early so that if there's any issues, you can communicate them with your banker or your other advisors, and you guys can get together to work how to pull that information. And so you can understand how this information is important for marketing your business. Another key important aspect of this is just to be as transparent as possible with your advisors. Make sure that you're communicating any issues that you may have with them as soon as possible so that they can help you work through them. So your next key advisor is going to be your sell side quality of earnings team, which is what I do. What we're going to do is we're going to get your key financial information. So your monthly P&Ls, your monthly balance sheets, your trial balances, and then we're going to aggregate them into what we call a data book. And we are going to perform a number of analysis to help support the investment banker's marketing materials and also make sure that you're getting the best possible earnings amount for your business. So our key analysis here is really the adjusted EBITDA. And our first step really with adjusted EBITDA is going to be to help validate the adjusted EBITDA that is presented in your confidential information memorandum. So we'll reach out to the bankers and get the financial information and the calculations that they got, and we'll essentially validate them through tracing them to supporting calculations, recalculating those calculations, and getting any source documents that are needed to further support that information. It's just important to understand that any amounts that are being added back to make your earnings larger, a buyer is going to want to see how those amounts were calculated and substantiate those amounts to make sure that you're not inflated earnings to get a better purchase price. In addition, we're going to do some initial analysis and digging primarily through a financial due diligence meeting where we'll go over all your key accounting policies. We'll analyze your chart of accounts, and we'll try to get an understanding of what activity flows through each account, how the amounts are trending month over month and period over period, and discuss any unusual results that might be in an account balance. So through that, we can further revise your adjusted EBITDA to make it a more accurate number. We're also going to really roll forward that amount to the trailing 12-month period. Essentially, that's going to be the most recent month and the preceding 11 months from that your business has closed their books. So it's the most recent and most accurate number. Another key analysis is going to be net working capital analysis that I'll discuss later. And again, any other additional financial analysis that your banker or that you would like to see for your business to help maximize its value. Okay, so before I go on, I think it's kind of important that I discuss EBITDA and net working capital. Really, what do these acronyms stand for and why they're important? So EBITDA stands for earnings before interest, taxes, and depreciation and amortization. It's also important to clarify that when I say taxes, I mean income taxes and not things such as property taxes. And the reason why interest and taxes, depreciation, and amortization are being added back are: first, interest is a function of debt. Typically, deals are done on a cash-free, debt-free basis. So essentially, as a seller, you're going to get to keep all your cash. However, you're going to have to pay off all of your outstanding debts so that when a buyer takes over the business is unencumbered. So because of that, interest is taken out of the calculation. Taxes is taken out of the calculation because it's based on how the entity is incorporated, what kind of business entity it is, whether or not it's a C Corp, a partnership, an LLC, which an entity can typically be fairly easily changed and may change at the point of transaction. So that's why income taxes are taken out. And depreciation and amortization are taken out because they're non-cash based expenses. So EBITDA at a high level is a proxy for cash flow. So essentially, anytime you're buying any sort of financial investment, what you're ultimately really buying is a stream of future cash flows. And if you really think about that, you could think about it, you might be buying a business for the technology, or you might be buying it for a patent. Essentially, even though you might be buying at a strategic level, those assets, ultimately you're hoping that technology, for instance, will ultimately yield a future stream of cash flows that people are willing to pay for a service or for a particular goods and service. Another reason why we like to use EBITDA versus just straight up operating cash flows is that it's much easier to quantify compared to operating cash flows. So how does that actually EBITDA function into selling your business? Well, what you're selling your business for is ultimately a purchase price, right? And a purchase price is typically calculated based on two factors. One, your adjusted EBITDA, which will help calculate, and two, an EBITDA multiplier. An EBITDA multiplier is based on a number of factors. Typically, it's a macroeconomic outlook and the industry that you're in, and a number of other factors that a buyer will help determine. Ultimately, as a seller, you're just really going to look at the high level purchase price and make sure that number works right for you and that you believe it's reflective of the value of your business that you've helped build. Okay, next, net working capital. Net working capital is current assets less current liabilities. Typically, the current assets that are included in this amount are cash, trade receivables, any inventory you might have, prepaid expenses, or any other current assets. Current liabilities are typically going to represent trade payables, accrued expenses, payroll liabilities, and any other current liabilities. So why is net working capital important? Net working capital it basically represents the amount of liquid assets and liabilities that need to stay in the business at a given time to maintain operations when a business changes hands from a seller to a buyer. So typically what we'll do is we'll help you establish what's called a net working capital peg, where we will adjust net working capital, and whatever that peg is, the amount of net working capital that's in the business at the time of transaction needs to be transferred from the buyer or the seller. So that's why net working capital is critical. Okay. So next, I kind of want to, again, reiterate the importance of your financial reporting team or your accounting team as a key advisor. So your financial reporting team is going to be providing all of the necessary financial data for a sell-side Q of E and for the investment bankers to help market your business and produce a SIM. Ultimately, when we get on the call with them, when we try to revise adjusted EBITDA and calculate adjusted net working capital, they're going to be the ones that are explaining accounting policies, explaining what activity flows through your chart of accounts, and any unusual trends that we can use. So what's the best way as a seller that you can really prepare your accounting team for financial due diligence and getting your financials ready for sale? So again, it's critical that you make sure that at a high level internally that your accounting team understands your general ledger and your chart of accounts, and they know what activity is flowing through each account, and that they can explain anything that's flowing through the business that's making amounts unsteady or uneven. Also as an owner, you're going to want to, when you look at your financial reports, you're going to want them to make sense to you. So as the owner, you might not be heavily involved in the financial reporting. You're running and growing a business. But when you look at your profit and loss statement and you see your revenues and your expenses and your bottom line, you want to make sure that those numbers make sense to you at a high level and that your accounting team can explain what's being seen there. For instance, if in the month of March, you had the best year ever, or the best month ever, I should say, but the revenue number doesn't make sense, that's the kind of discussions you want to have with your accounting team so that you guys make sure you're on the same page, that you understand what your financials are showing before you go to market. Okay. So what else is really important? It's important to have teamwork. It's important for your advisors to be aligned, that they understand what the goal is and really what we're trying to do. So, what is our goal? It's generally going to be to maximize the value of your business to get the highest purchase price, but it might be a bit more complicated than that. You might be trying to sell by a certain time, so you can retire and do other things in your business or other things. So you just want to communicate those to your advisors so that they understand kind of the timeline for the work that needs to be done and what the ultimate goal is. Another thing that you're going to want to align your advisors with is, what are we selling? Now, it sounds a little silly because typically, your answer is just going to be, well, I'm selling my business, but it might not be that simple. You might own multiple businesses. You might own the building that the business operates out of through a separate entity. You might have other businesses that interact with the business that you're looking to sell that are crucial for that business to continue operating at the level of profitability that you're looking to sell. So it's important that you establish a certain parameter of the transaction and that your advisors are all on the same page with specifically what you're selling. So typically you might own one business that doesn't have all of the expenses running through it that are necessary to run the business, so profitability looks higher than it actually is. In that case, you might want to include both of the entities together in the sale. And next, you're going to want to discuss with your advisors kind of how are we going to go through this process efficiently. And the best way I think to do that is really to have a kickoff call. After you have all of your advisors aligned and you know what you're selling, you're going to want to get everyone together and kind of discuss how information is going to be exchanged, is going to be uploaded to a data room where everyone's going to have access to. Is it going to be exchanged via email? How does everyone prefer to communicate? Do people prefer to get on the phone when there's questions or follow-ups, or do they prefer to work via email? Do people prefer to work, later at night or in the middle of the day? It's important really as your advisors that we have a clear understanding of when it's appropriate to also contact your accounting team, because this is really going to be like a special project for your accounting team. They're going to have to continue to run the business and provide their daily job duties to help continue moving the business forward. But then they're going to have this work on top of it. So it's important that we have an understanding of expectations of what your accounting team is ready to do and how many hours they're willing to put in. And if that really makes sense with the timeline that we're looking to establish. Okay, so next I kind of want to discuss adjusted EBITDA and some of the necessary adjustments that are kind of made and the ones that we typically find, and how you can help familiarize yourself with your chart of accounts so you can start identifying these adjustments to make it as efficient process as possible, so you can understand when you go to market when you look at your chart of accounts, okay, maybe these are some items that should be adjusted for. Oh, wow, my earnings are higher than I thought they were, or they are lower than I thought they were. So I'm going to discuss three key types of add backs. The first one is personal expenses. It's very common in my experience that owners will be running personal expenses through their business that have nothing to do with running the company. They could be, paying for their mortgage. They could be paying for their cars, vacations, the family cell phone bill. They might even have family members on payroll that aren't, providing any necessary services, or perhaps they're just providing services, but they're well over market from what if it was an outside party or you hired someone from the outside, what they would be. In my experience, this is really the item that I would recommend a seller spend most of their time really looking at. Oftentimes, it's difficult to identify these expenses because they might be recorded in different accounts at different times. They might be charged on a credit card, but it's important that you do the best that you can and as early as you can to identify these items, because this is one of the more challenging types, just because it's often difficult to track them down. I mean, you've been running your business and you need to go back 11 months and remember, where you charged a family vacation for $5,000 or something like that. But it's very valuable because these are add backs which increase your earnings, because as a buyer, these won't, they don't expect that these things will continue going forward. So that'll increase your EBITDA and ultimately increase your purchase price. Now, it's also really important that you make sure that you can identify these expenses on your general ledger, because your general ledger is going to drive your source trial balance, which is the basis of our analysis and quantifying adjusted EBITDA. If we can't find these amounts in the general ledger or your chart of accounts, then we can't add them back because we can't validate that they're actually in the reported EBITDA amount. That's our starting point. So it's really critical that a seller dives into these and gets an understanding of where they're being recorded and the exact amount and the month that they're being recorded in. The next item is non-recurring items. So typically any non-recurring items that are flowing through the business, we're going to want to add these back. So this can be both income or expenses. The big thing that I'm really seeing now, and that probably a lot of you have in your businesses, is you guys have received PPP loans and other government aid due to the coronavirus pandemic. So these things, unfortunately, can't be included in your purchase price, and they need to be taken out of EBITDA, reducing your EBITDA, because you can't expect for these streams of income to continue going forward. They're also non-operational and not really, the prime revenue generating centers of your business. So some other examples, you might have penalties or fines might be example of things that are non-recurring that might have happened that are expenses that you can add back as well. The third one that I want to talk about is accounting adjustments. So typically we make these adjustments if there is an error in accounting, or if the buyer is, using a financial reporting accounting that is different from the basis that you might be using. So a lot of small business owners, you guys may be recording your accounting on a cash basis. So you record revenues when you receive the cash, and you record the expenses when the cash is paid and leaves your bank account. And your primary concern is making sure that cash is coming in and that you have more cash today than you had the same time last year. Totally understandable. Typically, larger buyers will, use an accrual basis of accounting where revenues are recognized when the services are rendered or the goods are delivered, and expenses are recognized when incurred. So based on that, your accounts will change, and you can really count on your sell-side advisor to help make that transition from a cash basis business to an accrual basis business. So when your buyer's looking at it and comparing it, they're looking apples to apples on their end. Another big accounting adjustment that we typically look at is cutoff. So for instance, if you guys incurred expenses in 1 month, but you recognize them in another month, or for instance, if you guys paid for a cash expense, if it's on a cash basis, if you paid for a cash expense on the 3rd of a month, but you actually recognized it in the prior month. Essentially, we're just going to want to make sure that everything's in the right month, because again, our primary period of analysis is going to be on the trailing 12 months, which represents the most recent period that we can analyze your business based on the most recent month that your books are closed. Okay, your recasted P&L. This is kind of your catch-all when we kind of finish doing our financial analysis that we all really need to kind of be on the same page with before we can move forward and really go to market and have the buyer start looking at your financials. Essentially, a recasted P&L is your reported P&L out of your financial system, plus any EBITDA adjustments allocated to the specific accounts that will present your profit and loss statement on a recasted basis. So when we look at this, we should see that the amounts are relatively consistent month over month or period over period, depending on your analysis, and that they make sense to you as the seller at a high level, that when you look at your financials, you think, oh, this makes sense of the business that I've been running for the last 12 months, or this makes sense for the business in 2020 or 2019, depending on how far you're going back. So it's just important that that makes sense as kind of the catch-all to make sure that we've done a good job. Okay, next I'd like to discuss quantifying adjusted net working capital. So quantifying adjusted net working capital, some of the key items that we're going to pull are, we're going to pull out cash and debt because deals are typically cash-free, debt-free. And then we're going to pull out any non-operational items. So that could be due from related party balances. And we're also going to look to make any adjustments from a cash versus accrual basis. Some of the most common ones that I've seen here are a payroll accrual. For instance, you may be recognizing payroll expense on the date that it's paid, but on an accrual basis, it's based on when amounts are actually incurred. So for instance, you might have paid an employee, the last payroll run might be on the 28th, but then at the end of the month, those employees work the 29th, the 30th, and the 31st on an accrual basis accounting. You should recognize that expense at the end of the month. So we'll help quantify a payroll accrual and run that adjustment through net working capital and EBITDA. Another example might be prepaid expenses. You might recognize all the expense for a prepaid expense upfront when it's expensed. However, the benefit of that expense may last a whole year. So we'll adjust that by recognizing an asset and amortizing the asset over the life of it. Okay, so I'm going to speed up now because I realize I'm running out of time. Sorry about that. So net working capital is key because it's going to affect your purchase price. So for instance, if you are negotiating your net working capital for a seller, you want that to be as low as possible so you don't have to deliver a significant amount of net working capital at the end. So you just want to make sure as a seller, you understand how the amounts are calculated and what's flowing through that calculation. Okay, so your advisors are assembled and aligned, your marketing materials are prepared, and your financial due diligence is complete. At that point, your financials are prepared for sale. Okay, so what's next? Next, you're going to let your broker go to work and help find a buyer. They're going to bring you a number of buyers, and you should pick the buyer that works best for you, for your vision of the business going forward and whatever your personal needs are. Once you find a buyer, you're going to sign a letter of intent, which is a non-binding agreement that's going to outline a purchase price that they're willing to pay for your business based on an adjusted EBITDA that the buyer will validate and that we helped you guys quantify. Typically, a letter of intent has an exclusivity period where you will only be dealing with that particular buyer. Next, the buyer will come in and bring their due diligence team in and help essentially go through the same process that we went through and make sure that we're not inflating your earnings to overinflate your purchase price so you get more money than the business is actually worth. After that, you guys will finalize the deal, determine a net working capital peg, and adjust the purchase price based on the net working capital that is at the business at that point in time, and then your business is ready for sale. So finally, I just wanted to highlight the success factors, how you guys can, as a seller, just efficiently get through this process. First, build your team early. Second, make sure your systems are ready to go and that you're familiar with your books and your accounting records and your accounting policies. So when it comes time to dive into that, you will have answers to questions and to streamline the process. It's also important to communicate with your financial advisors and set reasonable communications so that everyone's on the same page. Okay, any questions? Steve, I can turn it back over to you for questions, I suppose.
Peter, just wanted to say thanks for joining us today. I think we ran out of time for questions, but what I would encourage everybody to do. No, all good. It's good information, right? So Peter's contact information is right up on the screen. Take down his email address or phone number, and you can certainly feel free to reach out directly. Peter, I do want to thank you for joining us today. Very interesting topic, and I think you have, as you and I both seen over the last 18, 24 months, a lot of businesses went to market before their financials were ready. And it creates a tough due diligence process in a lot of respects. So I think this is an important topic for companies that are even starting to entertain a sale, getting an assessment on how clean your financials are and what it would take to get them up to the point where a clean due diligence could happen would be generally a good idea and something that we recommend. Our snack basket giver for today is Lisa Snyder from Significance Inc. Lisa, congratulations. Somebody from our marketing team will reach out to get shipping information. And Peter, could we go to the last slide? Wanted to thank everybody for joining today. The next 2 weeks, we have some pretty good topics coming up as well. Next week, we're going to talk with Mark Daly from Newport Advisors. He's an experienced advisory board member. And helps companies build and run advisory boards, as well as serve as an executive advisor. So if you're wondering whether it's time and what it would take to build one, join us and with Mark next Thursday at 12 again. And then on the 10th, we're going to be joined by Dom DiBernardo, who leads our Citrin Cooperman CPM practice or performance management practice, to talk about what modern decision support looks like and how you can achieve great financial planning and reporting. Thanks to everybody for joining us today. Please watch your email for upcoming invites, where we're going to focus on a number of great opportunities and items coming up. Wanted to just say welcome back. This is our first session back, so thanks for getting back on board with us. We're going to keep these running through the spring, the rest of the winter and the spring, and we hope you have a great rest of the week and look forward to seeing you on future sessions. Thanks, everybody.